An unexpected and pretty stunning 50% plunge in chipmaker demand for Europe's most valuable tech company reinforces the notion that the global economy did stumble pretty badly this summer, with the consequences spreading out all over the world. That's why one of the biggest makers of luxury goods just reported a shocking decline in revenue. All of this more evidence for the fundamental background behind the bond market setting up its next stage, taking rates lower. ASML said its bookings for future business in the quarter plunged by more than 50% compared to last quarter and against analyst expectations. That's obviously a huge miss, and it shows something big changed over the summer. The company makes machines that make semiconductor chips, so it is upstream of huge chunks of the global economy. LVMH said revenues outright fell in the third quarter. Its bellwether division posted a 5% drop in revenue, the first negative for it since 2020. The company issued one of the most intentionally misleading statements I've ever seen about it too. Downright bizarre how they're trying to hide this global downturn. When they did finally come around to admitting it, they blamed, quote, an uncertain economic and geopolitical environment. All of this merely adds more solid, broad evidence for the fundamentals that are driving interest rates even lower. Both ASML and LVMH really drive home what those fundamentals are. The bond market has done what it always does after the start of rate cutting. Rates actually rise, surprising to most people. But once that consolidation, as the traders call it, once that gets out of the way, the next stage begins. And it looks like it already has in treasury bills, and especially with interest rate swaps dropping to new record lows. And we'll check in on those today as well. It's the fundamentals of falling growth expectations that are what ultimately drive interest rates, not the Fed or any central banker. Central bankers merely come along for the ride once they realize that these corporate reports are way too much like the macro data that we already have and the macro data that we're likely to still get down the road. No one outside of stocks is buying the September payroll report, nor the allure of China's massive stimulus. Instead, it's all about the downside of the cycle and a summertime that was indeed the time for recession. Now, ASML, which used to be called a long time ago Advanced Semiconductor Materials Lithography, which was a joint venture between Philips and ASM once upon a time, going back all the way to 1984, the key to note in that name, that former name, is lithography, which is the process of drawing some kind of design into a stone, which in this case means drawing the internal working mechanisms of semiconductor chips on the chips themselves. So ASML designs and makes all of these machines, which makes the computer chips that are the most advanced and sophisticated that are out there. Their photolithography machines are exactly what is needed for the most advanced 3 nanometer and 5 nanometer chips, which make them an effective monopoly. But that also means that anything having to do with the most advanced semiconductor chips has to go through ASML. So this is not just about the AI bubble, it's also about a ton of what seems to be older stuff, the stuff that goes into pretty much every part of the goods economy these days. That's what made ASML Europe's most valuable tech company. And they accidentally released their quarterly report yesterday, which seems like an honest mistake, but it didn't really change anything because once the management had their conference call, it actually kind of made things a little bit worse because they really didn't have any good answers for all the questions that were raised. The stock was down 16%, which is the worst single day in 25 years. That was yesterday. And then today, after the earnings call, it's down another 6%, which is a red flag for the entire global economy, which is what they're really saying here. The results point to what was supposed to have been a recovery and rebound in the chip making space, not because of AI, that's a growth part of it, but really because after the last several years, going back to 2020 and 2021, many in the technology space, especially in semiconductor chips, believed that there was actually a recovery, that the price illusion was a signal for sustained growth all the way into the future. Well, they got disabused of that notion in 2022, which led to a very painful downswing inventory correction cycle. And what ASML was thinking about last year, as many people around the economy were, was that downswing in the inventory cycle would finish up in 2024, and maybe by the second half of this year and on into next year, chips, if not the entire global economy, would be on into recovery. That's what they've been saying, and that's what they've been expecting up until this quarter. So the third quarter earnings were fine, and they said last year 2024 revenues would be similar to 2023, and they do appear to be. However, the idea that things were going to start moving in the right direction the second half of 2024 and then really start to maybe take off in 2025, that took a major hit. According to the latest report from the company, their third quarter bookings came in at 2.63 billion euros, which was more than 50% less than the second quarter. It was actually more than 50% less than what analysts were expecting for this quarter. And that's the same as last year's bookings in the third quarter of 2023, when last year was supposed to have been the bottom. That was supposed to be the end of the inventory correction, everything looking forward from here. Plus, when you factor in the additional business that the company's getting for AI, what does that mean for everything else? And of course, this is related to everything we already heard from Intel, because ASML is upstream of Intel, which means we're seeing all of these global weak spots develop in all of these various places, and it's not just one place or another, to the point that it's affecting investments and productive capacity. Companies are saying, we wanted to grow our productive capacity. We wanted to be able to make more chips because we thought demand would be there, but the demand isn't coming back, so we don't need more machines to make more chips because we can't sell the chips that we have right now. Of course, that's why Intel a couple months ago announced that it was undertaking these radical cost-saving measures, including laying off, and this was their quote, at least 15,000 employees. And the forecast for ASML, they had been saying that revenues for next year would be 30 to 40 billion euros. Now they're saying 30 to 35 billion, so they trimmed a huge part off of the top, which doesn't leave them a whole lot of room for actual growth, because that's right in the same range. 30 billion euros is pretty similar to 2023 and 2024. So they're saying there's possibly not a whole lot of growth in the semiconductor fabrication business, which tells you a lot about the global economy. Chief Executive Officer Christophe Fouquet, he said, it now appears the recovery is more gradual than previously expected, and this is expected to continue in 2025, which is leading to customer cautiousness. So bookings declined in the third quarter, triggering this rejiggering of forecasts for next year revenue, really downgrading them substantially. And the company says our customers are now uncertain about their customers because something changed over the last quarter. Lots of spin here. We're going to see even more of it as we go into LVMH. But I also want to remind you that we're winding down our fall sale here at Eurodollar University, where we have the best prices on all our products, the daily briefing, the daily deep dive analysis, and of course our EDU memberships. We're still offering incredible discounts on everything. If you want to know how the monetary system works and how it really affects the economy and what it tells us about the economy and economic prospects as well as markets, our subscriptions have got you covered. I also want to let you know that we're going to do another live Q&A this coming Tuesday, October 22nd, here on YouTube, 6:30 p.m. Eastern Time. So check that out. The details about all of it, the subscriptions, the savings, the live stream Q&A, everything can be found at our website, eurodollar.university. So like I said, there's spin like we got from ASML, which is more honest. Hey, we don't really know what's happening here. Lots of uncertainty. In this case, it's actual uncertainty, but we're being more cautious because we see that in our business, something big has changed. Then there's the spin that we got from LVMH. Now, they reported a decline in revenues, but you've got to see what they said on their website, because this is one of the most misleading statements I've ever seen, as I said in the introduction. And I'm showing you here exactly what I mean, because you really got to see it to believe it here. It's under the headline, LVMH shows good resilience in the current context. So already we're in the spin zone. In the rest of it, I mean, it sounds like a central banker talking about rate cuts and QEs. Good resilience in the current context. At least it wasn't worse. That's their setup. And then it says this: Europe and the United States posted slight growth on a constant consolidation scope and currency basis. Japan continued to achieve double-digit revenue growth. The rest of Asia reflected in particular the strong growth in spending by Chinese customers in Europe and Japan. In the third quarter, the slight decline in revenue mainly arose from lower growth seen in Japan, essentially due to the stronger yen. And as you can see, I'm not rearranging the text whatsoever. If it seems like it doesn't make any sense, it's because it's not really supposed to make sense. And when they finally got to the decline in revenues, this is what they said. In an uncertain economic and geopolitical environment, the group remains confident and will maintain a strategy focused on continuously enhancing the desirability of its brands, drawing on the authenticity and quality of its products, excellence in distribution, and agile organization. And there are those words again. After hiding it into the context, an uncertain economic and geopolitical environment. It's not uncertain, it's a downturn. And we're entering the worst stage of a downturn because we can see it in all of these results. Whether these companies want to admit it or not, they can call it uncertainty all they want. It's all about globally synchronized downturn. And their revenues for LVMH declined 3% year over year in the third quarter. And you can see the slowdown coming. In the first quarter, they reported 3% growth. And then it was 1% in the second quarter and now minus 3%. So it's not just lower income consumers that have lost purchasing power, are now fearing for their jobs and incomes. It's not just middle income consumers who for a little while there felt like they could shop at luxury goods because the government had handed out a bunch of handouts and they were spending on luxury goods and things like that. It's also the top end income earners who are becoming more cautious as well. So again, what we're seeing across the global economy, whether it be chips or luxury goods, is more widespread weakness. A downturn, a deceleration, and an acceleration in the downturn in the summertime. But of course, many people are going to say rate cuts and China stimulus, that has changed everything. And here's an example from the New York Times. We are not sure this quarter particularly changes the LVMH story, at least analysts at Bernstein wrote in a note. Even without a lot of detail, the stimulus signals in China are encouraging and demand will return, the analysts said. Everybody wants to believe in the magic of rate cuts. Everybody wants to believe in the magic of Chinese stimulus, even though there's historical precedent, even recent history, especially for China, that none of these things actually work. They can throw around huge numbers all they want. They can wow shareholders on certain exchanges. The real economy is a much tougher sell. And that's what we're seeing, these fundamentals in bonds and interest rate derivatives and everything else. No one is buying the September payroll, the central bank rate cuts at the Fed or the ECB or anywhere else, nor China's stimulus. That includes energy, as I talked about yesterday. Oil prices aren't buying this either. So what we're seeing is ASML and LVMH are really setting up for the second stage of the second leg of the bond rally. I know that sounds a little bit confusing, so let me review here. We had the bond rally, which began last October, so over a year ago. Rates started to go down as the market participants became more comfortable with the disinflationary situation, which was a reflection of, as I always say, disinflation is not the good news, weakening global fundamentals, especially in the United States and its labor market. We saw the data start to inflect around October last year, too. Following that first leg of the bond rally, which finished up at the end of December, there was, as I said at the time, and I continue to say all through that period, there would be a multi-month pause, which is, like traders say, a consolidation. And that lasted from January, February into March and April. And then at the end of April, we started to get signs that the second leg of the bond rally was happening because there was another inflection in the U.S. labor market, U.S. economy, as well as the global economy. The seasonal upswing, for example, that we saw in Europe, the small increase that was tied to last year's China stimulus that started to peter out. And by the middle of the year, the bond market was anticipating correctly that things would turn in an even worse direction by the summertime. So the second leg of the bond rally preceded the stumble in the global economy, and that kept up until we got the fireworks in August, which was the yen carry trade reversal at the center, which was all about the U.S. recession risk that was priced into CLOs or priced into perceptions of fears from Japanese participants. So everything that's happened up until now has been according to that same typical pattern, including after getting the rate cuts out of the Federal Reserve, which did not want to cut rates at all up until more recently, you would think that rates would continue to go lower after the Fed finally announces it's getting itself out of the way. But history shows again that in the short run, after the initial rate cut, interest rates in the market back up. And they did exactly that. In fact, they backed up in almost exactly the same way as we saw in, for example, 2007, by the same amount at the same period of time. But that didn't mean, like the pause earlier in the year, that didn't mean the market was re-changing its mind about fundamentals. The fundamentals have been the same all along. It's the variations and vagaries of dynamic marketplaces. There's fluctuations and nothing ever goes in a straight line. The fundamentals that we could see in a number of different ways, not just macro data and these corporate reports, from the markets themselves and how they were behaving even as rates backed up. For example, treasury bills. Treasury bills are a good example that are showing us why maybe we're very likely looking at the second stage of this second leg of the bond rally. 4-week treasury bills, as I talked about last week in a live stream I did about collateral, 4-week treasury bills were 5.55% back in early August, and then they plunged the rates actually plunged. The equivalent yield fell all the way to 4.78% by the time we got to September 24th. But then from September 24th until October 4th, the 4-week treasury bill rate went from 478 to 501, so a big increase, which is really the bill coming back off of that collateral shortage, as well as being consistent with this overall pattern I'm talking about. But since October 4th, the 4-week bill is now moving lower again, suggesting that we are heading into that second stage. Same for the 3-month treasury bill. That one had been as low as 4.69% by the 24th of September. Then it moved down a little bit more on the 26th, and it was still 4.68 on October 3rd. So it only backed up to 4.77%, and now that one's moving back lower too. So the bills are telling us that it looks like the second stage of the second leg of the bond rally is already beginning at the front end, which is where it would begin, because in this bull steepening mode that we're in, short-term interest rates are going to go down farther and faster than those at the long end. Behind all of that, we've got the interest rate swap market that hasn't budged at all. Again, telling us and pricing for us these fundamentals. In fact, the 30-year swap spread last week on the 8th dropped to a new record low and then revisited that low on the 10th, and as of yesterday is still only a basis point above it. So the 30-year swap spread continues to move solidly lower, which is not a good sign for anything. That's, again, the fundamentals from that perspective. The 10-year swap spread, that hit another record low for that maturity on October 10th as well. When I mean record low, I mean in the SOFR version of interest rate swaps and swap spreads rather than the LIBOR version. But even these SOFR versions, when you add a conversion factor, they're down among some of the lowest and most negative swap spreads from the LIBOR years as well. That's the market saying that expectations are rising for not only rates to go lower, but most important and most alarmingly, to stay there. And everything that we keep hearing, including what we just got today from LVMH as well as ASML, is consistent with all of that. Now that the Fed's cutting rates and the market can see the fundamentals, everything is moving in that direction. ASML, their stumble in the third quarter, especially the dramatic cut in bookings, their trimming of forward guidance, all of it points to something big changing with their customers. And their customers have their hands in everything around the global economy. So their customers are saying, hey, we were relatively optimistic for the second half of this year and more optimistic about next year, but now we're just not seeing it. So ASML's business falls off. LVMH businesses fall off too for the same exact reasons, but from a very different perspective. And all of it just confirms what the fundamentals have been driving interest rates lower. And the interest rate market itself, cash market and treasuries, for example, it has just continued along consistent with the historical pattern with every single up and down along the way, including the backup in rates that follow the initial rate cut. Now that we've gotten that part of the process out of the way, it's again back to fundamentals. And the fundamentals as we see in, for example, interest rate swap spreads. All of it is related. All of it is consistent. All of it is coming at the same thing from very different angles and coming to that same conclusion. The cycle is still a cycle. It's still cycling into the downside in terminal stage. The 4-week Treasury bill in September, that screamed collateral. And the collateral indications kept on going into October, which is why I did a live stream about it last week. You can see the replay of it at the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. If you want to become one, check out our fall sale. Get a live Q&A next week. And until next time, take care.